Now we will take a moment to introduce you to our speaker. Our speaker today is Paula Bedford. Paula is a leader in the firm's public sector assurance practice focused on not-for-profit organizations. She most often manages and serves as a reviewer on audit and single audit engagements, working directly with her clients to build lasting relationships. While Paula holds experience in several industries, she is primarily focused in the public sector. Paula, you may begin the presentation.
All right, thank you so much, Ashley. Welcome, everyone, to the 2024 Nonprofit GAAP update for this year. So I'm going to talk here just a little bit about what we're going to go over today in this webinar. As it is only an hour long, we're going to kind of limit what we're going to discuss today. So today we will talk about the new accounting standard update that is impacting the nonprofits for this year. Luckily, it's been pretty quiet in terms of new standards that will have significant direct impacts to nonprofits. But nonetheless, this will still be an adjustment and need work on behalf of each organization in order to get this fully implemented and comply with the new standard. So the new standard that is coming into play is ASU 2016-13, financial instruments for credit losses. So this is topic 326, measurement on credit losses on financial instruments. So better known around the accounting world as CECL. So current expected credit losses. So when you hear CECL, this is what the new standard that they are referring to and talking about. So we'll take a deeper dive into what that looks like and how that's going to impact nonprofits in particular. And then I also will be talking about one of the most unique and significant pieces in regards to nonprofit accounting. So revenue reporting. This is by no means not new. These new standards for revenue recognition have been out now for several years. However, this continues to be a challenge for all nonprofit organizations. So if you are out there thinking, yeah, that's me, you are not alone. Like I said, this came out several years ago. It had several different impacts regarding various types of transactions, but mostly circling around the contributions pieces. So we'll touch about the contributions, and we'll also touch on various exchange transactions as well. All right, but first up, we have our first polling question. Okay, so we'll move on now and we'll talk about this new ASU that's coming into play. So once again, it's ASU 2016-13 for financial instruments over credit losses. Okay, so this current expected credit loss model and standard that's being implemented requires the immediate recognition of estimated expected credit losses over the life of a financial instrument. So this includes loan receivables, your trade receivables, net investments in leases, and other certain off-balance sheet exposures. Today, I'll kind of focus mostly on those pieces of which would be more relevant for a nonprofit organization. As you're thinking and hearing just about this standard, as a nonprofit, you may be wondering, why is this impacting me in any way? Should this be aimed more towards financial institutions? And yes, financial institutions, banks, they're going to have more significant impact in regards to this, but this still does impact all nonprofit organizations. And that's my job here today, is to try to help alleviate some of that worry and get you moving in the right direction. So this is going to be effective for fiscal years beginning after December 15th, 2022. So for your calendar year-end organizations, so for your 12/31/23, this is going to be implemented with your current financial statements. And those of you that have a fiscal year end, so you'll see this with your 24 year-end implementations. Additionally, this guidance, so this is under topic ASC, so Accounting Standards Codification -20 should be applied to financial instruments that are in scope using a modified retrospective approach. So what does that mean? It means that you're required to recognize the cumulative effect of initially applying the impairment standard as an adjustment to the opening net asset balance in the period of the initial application. So very similar to how leases for probably many organizations was implemented. The cumulative adjustment for this year, if needed, will be the difference between the previous model that has been in play historically and this new model that's in play now. All right. So the CECL objective. So really, why are they doing this? What is the reasoning behind it? As I mentioned, the approach is to recognize impairment losses on the financial assets throughout the entire life of that asset and to recognize those immediately. This has been a weakness in regards to the current GAAP, how it is written, resulting in delayed recognition of various losses and leading to increased scrutiny over the years. So FASB brought this one out and hopefully to amend that, make those losses get recognized quicker and have enhanced disclosures and enhance the reader's knowledge of how an organization is accounting for those losses and recognizing those impairments as needed. The objective of the CECL model is to reduce the complexity under US GAAP by decreasing the number of models that are being used currently to account for these financial instruments. It also eliminates the barrier to timely recognition of the credit losses by using the expected loss model instead of the incurred loss model. So currently, in the previous GAAP, we have just been recognizing losses as they come into play. So now this is going to be the expected loss model over the life of the asset. It's going to be recognized on day one. As mentioned, it will require an allowance over the lifetime of the expected credit losses. However, with this new model, the standard does not dictate what specific model you as an entity have to use. That is definitely up to the organization and their operations and what they feel best is the correct model, the correct method under this model for using for the year. And that may change on a year-to-year basis. So just kind of keeping that in mind. As with any new standard that comes into play, this also requires enhanced disclosures in your footnotes. I know we all love that, having to add a few more pages into our financial statements is always tough. But again, it is just to help enhance the reader's knowledge about what is going on within the organization. All right, so here we will take a look at what is in scope for this new model and what is out of scope. So what is being covered and what is not. So the big items here, so we have the trade receivables and your loan receivables. I will say those are probably the two most common areas that will be affected with this change for nonprofits. There's also held to maturity debt securities, receivables from repurchase agreements, net investments with sales type and direct financing leases, and reassurance receivables and financial guarantees. So today I will go into a little bit of a deeper dive in regards to how this directly impacts trade receivables and the loan receivable pieces and what you as an organization can do about that. The out of scope pieces are your current investments that you have that are recorded at fair value. So those do not need to be addressed or changed in regards to how that reporting is done underneath this new model change. Available for sale debt securities are also excluded. Loan receivables that are held for sale, contributions receivable. So this is excluded as well. So think your pledges receivable. So anything that is coming from what is labeled as a condition, as a contribution under revenue recognition. So those pieces are completely going to be excluded from this new CECL model. But I will say, in saying that, you still need to determine if your receivables under your pledges and promises to give are collectible, and still need to do that analysis regarding that, but it doesn't need to be under the new CECL model and the method of how to do that. And then loans and receivables between common control entities. So think parent and subsidiary type relationships. So those ones are excluded from this new model as well. Operating lease receivables. So again, this is the new lease standard that came out last year. So anything in regards to those leases that are out there, those are out of scope for this as well. And then equity method investments and derivatives as well. All right. So now just a couple of changes that we'll talk about here in regards to the two different models. So the model from the previous years is what was called the incurred loss model, and the new model, which is the current expected loss model. So unlike the incurred loss models that were existing previously, CECL does not specify a threshold for recognizing impairment allowance. So an entity is required to recognize an estimate for expected credit losses for an asset at the end of the reporting period for all of the assets that would fall in scope. A credit impairment would be recognized as an allowance, or a contra asset to that financial asset, rather than a direct write down of the amortized cost basis of the asset. And again, reporting entities should record the expected lifetime credit loss. So lifetime as in over the life of the asset within the scope of CECL through the allowance account for credit losses. So previously, losses had been recorded when probable of being incurred. And now these need to be recorded at day one. What is the potential for being the expected loss at day one of this financial asset? Also previously, there was no indications. If there was no indications of loss, there was no reserve recorded. And I will say that was, very common with many, nonprofits that would historically never have collection problems on any of their trade receivables that were out there, and therefore no allowance was ever recorded on their books. So that really just the methodology kind of has to change in regards to now a deeper thinking of what an impairment can be and how it could come into play. So, like I said, historically, it always has been based off of historical experience. So something that has happened in the past. We never had collection issues with this client before, this customer, so we don't need an allowance for them. New thinking, we still can think about historical, but we have to update it for current data, current knowledge that we know about the situation. What do we know about the customer and the area that they serve? in their environment. What do we know there? And we also have to look at forecasts for the future. So reasonable, substantiated forecast. So it has to be some type of thought in regards to that. So we went from historical now to historical plus updated for current and forecasted for the future. So that's kind of one of the bigger changes there. And typically, we have only ever put an allowance on past due amounts. So amounts that we already knew were late on being collected. Think of trade receivables. So those are sitting like well over 90 days, 120, 180. So we're putting an allowance on those. But now we have to think about all of the balance. So even those current balances, even those the ones that you just released and they're sitting in the 0 to 30 days, those need to be considered into the calculation of whether there's an expected loss on this over the life of that asset. So that, again, a different way of thinking when it comes to all of that. All right, so we'll go with polling question number 2. What motivated you to register for this webinar? Okay, the measurement of CECL. So the measurement of CECL requires an entity to determine the allowance for the credit loss based on amortized costs of a financial asset. So what is an amortized cost? So by definition, amortized cost basis is the amount at which a financing receivable or investment is originated or acquired, adjusted for applicable accrued interest, accretion, or amortization of any premiums or discounts, deferred fees, costs, collections of cash, or write-offs in regards to that. So your starting base is going to be your amortized costs of that financial asset. So that's your first thing that you need to do. What is the correct value that you are starting with in order to do this allowance determination? And additionally, the measurement is going to be made on a collective pool basis. So you're going to be pooling your assets together. So with similar risk characteristics across your multiple various financial instruments. So it means you need to group your assets by like within a pool. This can be done in various different ways. So I would say probably the most typical way that I'm going to see would be a financial asset type. What type of asset are we going to be evaluating? So that's probably the most common. So, bulking up all of your trade receivables or all of your loan receivables. This also could be done by size of the financial asset, the terms that are under those, various locations of potentially where those assets are sitting or lying, and just various credit loss patterns. But again, I feel most of them for the nonprofits will probably be done by the financial asset type. The ASU 326, so the standard does actually provide a very good list of potential pools that could be used. As noted, pools can change. So these are not to be static, and they should be reassessed every year to make sure that your pooling of those assets still appears reasonable based off of what you know in regards to them. Lastly, CECL does not tell you which method you need to use. So you can use whichever method you feel fit for your organization. So it will depend greatly on the facts and circumstances of what is going on at your organization, including complexity and the significance of those financial assets to you and your books in your operations. Some of the various models that can be used, as were kind of listed and noted underneath the new standard for the CECL model, is discounted cash flows method. So this is where you are determining what the expected credit losses are by comparing the amortized cost with the present value of the estimated future principal and interest cash flows. So I'm kind of thinking maybe something like this would be for maybe some of those loan receivables that you would have out there, right? There's a loss rate method. This is where estimated loss rate to the asset's amortized cost basis. A rate roll method. Expected losses are determined by using historical trends in credit quality indicators. So delinquency, what is the risk rating in regards to those assets? The probability of default method. So this would be by multiplying the probability of default, so coming up with percentage by the loss given the default. So the percentage of asset not expected to be collected because of the default. That one's probably a little bit more complex in doing that. And then another one, which I would feel would be most common, particularly with our trade receivables, would be the aging schedule. So taking your aging schedule and determining what the expected credit losses are by those various buckets. So using that current bucket, the 0 to 30, 30 to 60 day buckets, and setting a percentage in regards to each of those. Okay, so continuing with the measurement of this, so you still need to evaluate information both from an internal and external standpoint. And gathering this data could be difficult and challenging, particularly in external type data, in helping estimate credit losses. I will say the standard does say, they do not want an entity to spend, considerable amount of time that results in undue cost and effort in regards to finding some of this data. So just kind of think of that, from a cost benefit analysis in regards to how you are gathering the various data points in order to make this measurement happen. So the entity should develop an estimate of the credit losses based off of historical information, which you have been doing already from the previous model, plus the adjustment for current conditions and any reasonable and supportable forecasts. This requires an entity to estimate and recognize an allowance for credit losses, even when the expected credit loss could possibly just be remote. You still have to go through that analysis to determine that it is remote. And again, you have to do this over the lifetime of the expected credit loss, so over the lifetime of the contractual agreement that is in place there. You would use the balance sheet date kind of in regards to that standing point of where you need to go to determine what is the life of that financial asset. Also, in the year of adoption, a roll forward is required in regards to the impact of initially putting the standard into play. So as I discussed before, you need to determine what the cumulative effect of the adjustment at the beginning of your period would be. The roll forward is not required for prior comparative period in the year of adoption, but it is required for periods in which financial statements are presented in subsequent periods. So, just keeping that in mind, you still need to figure out what this effect would be. We're going to use 1231 as an example. So what would your effect of this standard be on your financial statement as of 1/1/23? If you are a 12/31/23 year end, so that's kind of where you see where it starts. how it affects those beginning balances, and then how it rolls forward through to the ending balance. All right, so write-offs. Yes, write-offs still are happening. This process really hasn't changed. So once you figured out that a write-off needs to happen, that it is uncollectible, that write-off needs to occur and it needs to be recorded. Again, writing off something could use significant judgment in regards to the assessment, or if you completely know you will not get it, it will need to be written off your books. One of, I believe, the biggest questions I'm sure will be asked is, can an entity have a zero expected credit loss? And this is probably something that a lot of entities are asking for those that historically have never recorded an allowance on their books for their receivables. And don't worry, the answer is yes, that can still happen, but you still have to go through the analysis to make sure that you are thinking about the historical conditions adjusted for the current conditions and forecasts. So you still, again, have to go through all of that analysis to come to the conclusion that it is a zero expected credit loss. So to have a zero expected credit loss, essentially it means that really there's a zero loss expected with the current and the forecasted conditions. So again, it has to be all three, kind of like all three of those pieces into play at once to make that happen. So some of the great, probably I would say bigger zero expected credit losses are going to lie with those governmental entity receivables. I know many nonprofits do receive grant funding from the government entities. So this type of receivable would most likely be expected to have a zero expected credit loss in a lot of scenarios. So don't get too hung up on that, especially if you have big grant receivables on your books and they are coming from the US government. This is something that you would be able to analyze and say, yes, this is funding coming from the US government. Here's guaranteed funding, and we expected this would have a zero credit loss related to that. All right, polling question number 3. Are you still here? All right, so CECL and trade receivables. So a trade receivable is a type of receivable that's coming from ASC 606. So your exchange type transactions. This is obviously one of the more common asset classes that are going to fall under the CECL model for entities that are not financial institutions. So like I said, this trade receivable will be the biggest thing that will probably come into play for your entity. The allowance for the credit losses on your trade receivables should include, obviously, all of your trade receivables, any contract assets as well. And it should be at amortized costs, so less any discounts and premiums that are applied into there. As we talked before, there will be a pooling of trade receivables. So again, you have to pool the assets that are involved. A lot of times the aging buckets is probably the most efficient way to do this for nonprofits. But also you can think about it from location and customer industry as well, where those receivables are coming from. And again, remember, current receivables also have to be considered under the CECL model. So it's not just those that are already past due. Okay, so some nonprofits do also have loan receivables as part of their operations, and in some instances, they are highly significant. to that nonprofit. So additional things, that need to be considered when talking about these loan receivables is, like I mentioned before, taking into account accrued interest, discounts, and premiums, forecast periods for the life of the loan. Forecast, you have to do that forecasting out through the time period of the loan. And if you can't do that, you can revert back to historical losses that you have incurred. But again, that's another deeper analysis, and reversion methods must be applied. I'm not going to go into detail in regards to that, but just know if you are unable to forecast out reasonably through the life of the loan, you can go through a reversion method as well. And again, the pooling as well. So risk pools and credit quality indicators, particularly with loans. What type of risk are they? Are they, have they been delinquent historically? And also what type of collateral is involved as well in regards to these loans. Okay, so disclosures. We all love new disclosures in our financial statements. So some of the new things that need to be put into your financial statements now in regards to this new standard is management's policy for the allowance for the credit losses. So what is that written policy that is in place for determining that allowance? We must now roll forward the allowance balance. So you have to have your beginning, what changed. So what was added, what may have been removed via write-off, and what is your ending balance. So all of those should tie out. Any aging analysis of any past due amounts in regards to that. Talk about any of your credit quality indicators as well. And as mentioned, that first year does need to have the impact of the initial adoption disclosed in that roll forward. So I did put an example on here. Very round numbers. You have your beginning balance initially at 1/1/23, which would match your opening balance, but then you have to figure out what the impact of changing that models would have done as of that beginning balance. So take into account your previous model you used, apply your current model on those beginning balances, and record that change there. So you have your adjusted beginning balance. More often than not, that adjustment would increase that allowance that is out there. And, big picture thinking, with any new standard, you should be determining the scope and materiality of this standard's impact on your organization. Is it material? Will it be material? I know us as auditors will also be looking at that and considering that as well. If you determine it has a material impact, the policy for the allowance for credit losses does need to be written, needs to be disclosed, and you have to determine that methodology for calculating out that CECL allowance. However, obviously, if you determine it is not material between the organization and in agreement with the auditors, that can be done as well. Obviously, that's a discussion between you and your auditors on how to approach that within your financial statements. So just something to consider because this could have, varying levels of impacts on the organization, could cause some additional work that needs to be done internally, and you just want to making sure that it's worth your time to do this implementation. All right, polling question number 4. What areas do you need support with this year? All right, so now we're going to go into some revenue recognition. Again, while this is not new, this is still causing significant challenges to many organizations, particularly as new funding continues to come out every day. with, even with the federal government, with states and local governments are, passing through all this additional funding. Foundations are giving out more funding as well to help keep organizations moving, keep them afloat, keep them trying the new things that they want to do. And I know this has been heartache for many organizations trying to read through all those agreements, trying to understand them, trying to figure out what reporting model they need to use, and making sure that they are applying that consistently. So for those of you on the webinar that do get your annual audits each year, you will know that your auditors will put this as a significant risk area for all nonprofits. So revenue recognition is a significant risk that must be assessed and determined for each audit. So which means they're going to dig into this and continue to dig into this even more and more. With the new look of some auditing standards that are coming out for auditors for this year, this may even heighten it in some situations as well, as obviously it's significant risk. So applying even more procedures that maybe have been done in the past. So just things to kind of think about in the back of your mind as you're rolling through into this new audit season. So I'm going to go through just 3 kind of main types of revenue transactions that the NFPs typically have. So we'll have your non-exchange transactions. So these are your traditional contributions that you have coming in from your donors, from foundations, individuals, various companies, or even the grants that you have coming in from governmental agencies, and also promises to give as well. And then we have our exchange transactions. So this is what you would call your 606 revenue transactions. So exchange transactions follow the ASC 606 guidance. So if an auditor ever mentioned 606, this is kind of what they were referring to. So these are transactions in which you receive commensurate value for the services you perform for the entity of whom is providing the funds to the organization. And then agency transactions as well. So these are pass-through transactions where you would essentially record an asset and a liability on your books, but not revenue and expenses. I will go through a little bit more in detail on each of these, but I will keep it higher up towards the non-exchange and the exchange pieces. Okay, so this flow chart on the screen, I'm a visual person, so using this flow chart is helpful for me, as an auditor when I'm testing revenue and going through various transactions to determine which type of revenue stream this is. So I wanted to share this with you. This is coming straight out from the actual standard itself. So this is not something internally developed. This is right from the standard. But this should be kind of a starting point for each revenue source that is coming into the door. So starting at the top, does the NFP have discretion to choose the beneficiary of the transferred resources? So obviously yes or no. If that is a no, that is essentially you acting as an agent or pass-through of those transactions, and therefore that should not be recorded as revenue or expense on your books. But if it is yes, you keep going. So now we're going to determine if this is going to be an exchange or a contribution. So are you receiving anything of value in regards to the transaction? Obviously you have yes or no. So what value is being provided to the resource provider? If they are not receiving anything in regards to the money that they're providing you, that is a contribution to you. But if they are, what is the value? Like, are they receiving a significant value? Is it just nominal? What level or threshold is that value? So the yes or no obviously depends on what it is. If it is yes, that they're only receiving a nominal value, it would be a contribution. But if it is no, you have to determine what value are they receiving in exchange. And sometimes it could be a little bit of both. So think of transactions such as maybe a sponsorship or a membership in regards to your organization. Someone could be paying $100 for a membership for your organization, but they're really only receiving $50 benefit for it, and the other $50 is really a contribution to your organization. So that could be a little bit of both. So just a decision tree to kind of walk through to get there. And then agency and transactions, as I kind of went through, a very high level. So this is where the organization acts as an agent or pass through for another party. So essentially, someone could be unable to provide certain services, and they ask you, can you collect this money on my behalf and pay it out to these individuals as needed? So you need to make sure that those are recorded as asset and liabilities on your books. So any money that comes in through your door should be recorded in some way on your books. There really shouldn't be off balance sheet accounting when it comes to funds flowing into your organization. All right, so exchange transactions. So these are reciprocal transfers between two entities that result in one of the entities acquiring assets or services, or even satisfying liabilities at some point by surrendering other assets and services, including other obligations. So it means you're receiving commensurate value for that funding that's being received. Common exchange transactions within a nonprofit would be your fee-for-service arrangements. So think healthcare entities in particular that would have these fee-for-services, special events, and memberships as well. Keep in mind, revenue for 606 transactions is recognized as earned. So that is when the performance obligation is satisfied. And that is usually done either overtime, so overtime that the service is being performed, or point in time. So point in time would be, like sales of merchandise and things like that. So right at the point of sale, that's when your revenue is being recognized. All right, keeping along the lines of these exchange transactions. So contributions are excluded from 606 revenues. So those fall under the other reporting model, which is topic 958 for contributions. As mentioned, certain transactions could be both exchange and non-exchange. So you have to think about that as they're coming through and if those need to be split between the two. So memberships or sponsors, membership dues and sponsorships are very good examples of that happening. Private grants and government grants, typically, I will say those tend to fall under more so the contribution model, but there are certain ones that are exchange transactions, and those would need to fall under 606. So again, reading through that agreement to determine which threshold and level that falls under. And in regards to the ASU 2018-08, which is the contribution model, it does state that societal benefit, even though it furthers the mission, is not commensurate value. So obviously those contributions coming in that are for the mission should be contributions in that 606. This here is just, a chart of the various 606 revenues in regards to what would be in scope and out of scope. So included over here is on the left and the non-included is on the right. So your tuition and fees, for those type of institutions that may charge that. Any exchange grants, membership dues, sponsorship revenues, healthcare revenues, program fees, those are all the 606 type transactions. And then the ones that are outside of that would be contributions, non-exchange grants. So those are going to fall under the contribution model. Investment returns falls under a different revenue threshold. Rental income and leases, we kind of went through those last year with the new lease implementation. So those fall under something separate as well. So also another helpful flow chart I wanted to include in here to help make the determination between if it is an exchange or a non-exchange transaction, and the steps to go through and that determination in making that assessment. So I'm not really going to walk through this, but definitely something to have saved down as you're going through your analysis of each of your transactions to determine which way does it go. And then also, it helps with the determination of how to record contributions in regards to if they are conditional or unconditional. And we'll also kind of walk through that here next, because again, that's one of the bigger hurdles. All right, so as we know, for the contribution model, there are two types. There's either the unconditional contributions or the conditional contributions that should be recorded. So most entities do not really have issues with getting those unconditional contributions recorded. So when those come in, those will be recorded immediately once you are notified that you are receiving a contribution that has no conditions over it. The conditional ones are the ones that cannot be recorded until those conditions are met. And a condition is made up of two items. So there is a barrier to overcome to be entitled to the resources and a right of return. So in order for a contribution to be conditional, it should have these two items present. I will say the toughest one to determine is that barrier. I'll say more often than not, the right of return is listed pretty clearly within the agreements. It's the barrier that has the most challenging part in regards to trying to figure out what that truly is, if there even is one, or if there really isn't a barrier, but there is actually a donor restriction. So I'll talk about that here, but just the various types of barriers that could be there are the measurable performance barriers, limited discretion, or just related to the primary purpose of the funding that is coming in. So I'll talk about those in the next couple of slides here. Okay, so differentiate between the donor conditions and donor restrictions. So really this could be very gray. I know we hate hearing that, as auditors, as an organization, gray is not fun. That does involve a lot of judgment that needs to be placed on the organization just in regards to how they are analyzing this. But the guidance does have a lot of detail to help kind of get there in regards to what a true barrier is that would fall under condition and what a restriction is. So let's talk about, I guess, some of the barriers of what those could look like. The agreement could have a measurable performance related barrier. So oftentimes this could be coupled with a time limitation as well. Performance barriers could be anywhere from a specific level of service, identified number of units of output. So you have to service so many individuals, or you have to supply a certain amount of items. They could be linked to specific outcomes. These measurable barriers stipulate when the the recipient is entitled to the resources. And this also could be a matching situation as well. So think those entities that probably have annual campaigns. Sometimes you have a foundation that says, I will give you $1 million if you can raise $1 million. So that right there is a large barrier that they're placing on their potential contribution to you, as long as you are able to raise that $1 million. Another one is in regards to limited discretion over the manner in which the activity is conducted. So this one is where your federally funded grants fall under here. So they are limiting discretion in regards to how the funding could be used. So they're basically, for the federal grants, they're saying you have to follow 2 CFR 200. So uniform guidance in regards to this funding in order to be entitled to the funds. So kind of thinking along those lines. Also, they could say that you get this funding as long as you hire a new operations manager to run this program. So again, they're kind of giving you the how this funding needs to be spent. There also could be stipulations related to the purpose of the agreement. So again, this kind of falls along the lines where it could be you have to provide meals for 800 people to a homeless shelter for X amount of days or things like that. So really just kind of digging into there in regards to what the purpose of the stipulation is. And it really shouldn't be an administrative or a trivial stipulation. So administrative would be reporting. You're required to do an annual report. That would not be a barrier. That is more so a, not a significant, like a stipulation into how the purpose of the grant is operating. That is more, like I said, administrative routine task that just needs to be done in order to be in compliant with the grant agreement. All right, so donor imposed restrictions. So the restrictions limit the use of the contribution, but they do not affect whether the recipient is entitled to the contribution. The condition is what triggers the entitlement. And as we talked about, a condition must have the barrier and must have the right of return. In certain situations, it is hard to determine what the donor wishes are. So within the agreement, if there aren't stipulations that are not clearly unconditional, it should be a conditional contribution. So if you are not sure, kind of err on the side of caution in regards to that. But also, I am a big fan of reaching out to the donors themselves, the grantors themselves, and talking them through, what their intention is in regards to the agreements that they have. They know what they want and why they gave you the money in the first place. So they're very helpful in regards to directing the language that is written in those agreements and helping you follow how it should be reported and making sure that they are also in agreement with that as well. All right, so saying all that, what do we do after we, what does our reporting look like for each of these various scenarios? So as I mentioned before, on the unconditional side, you're going to recognize that revenue right away upon the notice of the award. And you'll classify that as appropriate within your net assets. So it could come with a donor restriction, or maybe it does not. So making sure if it does have those donor restrictions, you are taking note of those you're tracking those and getting those reported on that, lovely net asset roll forward. For those of you that have significant restricted assets, you would know that the auditors do request that and do look at that and test that pretty in depth. So keeping that updated through the year is very helpful in regards to making sure you're staying on top of your restrictions. Doing it one time a year is a big burden and a huge undertaking. So just kind of things to think about internally as you're working through. And then for the conditional contributions, so no revenue is recorded until the condition is met. So if you do receive the cash in advance of a condition being met, you have to record that as a liability on your books, right? And then once that condition is met, you can recognize that into revenue. And then again, classify as appropriate within your net assets. Is this with donor restrictions or without donor restrictions? So, keeping in mind the condition, so unconditional versus having a condition should be evaluated first, and then looking into the restrictions next. So it's kind of a step in the tier in regards to that flow chart that I showed previously. And then any conditions that are not yet met as of the end of your year, so whether it's fiscal year or calendar year, those should be tracked, and those do need to be disclosed in your financial statements. So even if you didn't receive the funding yet, but that money is available to you upon meeting those conditions, that amount does need to be disclosed. So thinking of potentially federal grants that you that extend past your fiscal year that you haven't fully expended, those remaining amounts there should be disclosed. Okay, and then a high-level summary overview just in regards to the revenue reporting. So step one, determine your type of transaction, exchange, contribution, or other. Follow that specific guidance that you need to follow based off of the determination. For those contributions, determine if it is conditional or unconditional as appropriate, and then determine if they have a restriction. Document and track those restrictions throughout the year to make sure that you are using each of those contributions within the donor's wishes. And you can clearly show that process being done and made throughout the year. And like I said, don't forget to update the net asset roll forward. Again, very helpful for an organization to do that as throughout the year versus on a year-end situation. I do know that was a lot to kind of go over for revenue reporting, but hopefully it kind of gives you a little more comfort, and a little more knowledge just in regards to how to get all those transactions reported throughout the year. All right, and then our last polling question. How do you feel about the topics we went over today? All right, and then as that closes, I'll just I'll leave this slide up here. We do have obviously a public sector webinar series. There will be 5 webinars that we have planned out for the year. There was one that was done yesterday that is now available on demand. Obviously the one I'm doing today, and then we have 3 more coming up. Those are all available for you to schedule out on our website, so you can sign up for those and make sure those are on your calendar for the years going forward. And that is all I have for today.
Thanks so much, Paula. This concludes today's program. Thank you all for joining us. With respect to your time, we'll be reaching out directly to answer all questions submitted. If you would like to learn more, like Paula mentioned, please visit Raymond's website at www.raymond.com. And you can also email us at publicsector@raymond.com. Thank you again and have a great rest of your day.